let's talk about how to realistically grow from 1000 to let's say 10k. If you know me, I'm a rather conservative trader, meaning I want to be very extremely realistic when it comes to my expectations and the results, but also at the same time I know for a fact as long as I'm being disciplined and patient enough, this will eventually pay off big time. So we having this $1,000 right here. Obviously, first things first, we need to having a plan, and by a plan I mean we need to know basically what to trade, how to trade, when to trade, and this is also really important. Basically knowing what to do and what not to do. So basically for the sake of this video, let's say I'm gonna be focusing on one of my trading strategies, which is basically this strategy that I'm gonna describe to you basically probably in like 3 sentences. Step number 1, we need to having some high time frame key level. Then we want to see some basically sweep, so liquidity sweep if you will, and I like to have the volume candle, something I kinda observe and created on my own, but this is pretty much bread and butter how I like to trade, obviously side by side with the SR zone. So just for the sake of this video, I basically trading usually the forex and the futures. When it comes to the forex, you know, the major one, which Euro USD is basically bulk or the majority of my trades. I like to trade NQ on the futures. Basically when to trade is also really important for me, statistically speaking. If I happen to trade intraday, I focusing on the first 2 hours of each session open. If I don't have enough time, I usually trading 1 hour or 4 hour time frame and basically having the similar type of signals and the setups. Basically what to do and what not to do, well obviously you should not be like over leveraging, things like that, but what not to do, well, will depend on the method that we're gonna be using. What I just said, it's extremely important for you to basically understand what is your average drawdown and basically winning and the losing streak, because if you know these 3 informations alone, you can tweak and you can manipulate your basically expectations really lot. Also it helping a lot if you know the Monte Carlo simulation. If you don't know what it is, basically a series of multiple different, you know, outcomes of your particular strategy. There are obviously some equity curve simulations that you can search it on the Google. I'm not gonna go too much into the details because that's like very separate video. Now once we having the plan, what we gonna do? Well basically we having the plan A and the plan B. It depends basically how you want to spend your money. So basically the plan number 1 will be focusing on the personal capital. So I would say trading the personal capital, you have to be okay that it gonna takes a little bit longer. Sometimes it might gonna takes way longer to get to these 10k, obviously depending on the risk exposure, things like that. I would say this is way more conservative approach, and comparing to the plan B, this having a little bit lower return on the investment, but that doesn't mean this plan or this method is actually bad, because this one is actually way more flexible comparing to the plan B that I'm gonna be describing later on. And basically there is no additional pressure on the performance. Basically I'm referring to the plan B because you have to tweak a couple things or two. So now plan A is basically trading the personal capital. So first things first, let's say the method A. Basically I, for both cases, for plan A and for the plan B, I having method ABC, stands for, you know, beginner, intermediate and eventually advanced. So the method A is you will have full allocation of that $1,000 basically on one account. You will have full allocation to your account depending on the brokerage and things like that. I'm not gonna be covering that in this particular video. Maybe if you're gonna be interested in the future, you can just let me know. Especially for the beginner trader, you should be focusing on the one particular strategy only. I really don't care if you see that your friend is making, you know, 6-figure every single month by trading like 6 different strategies, 6 different models. For you, what you need to learn first is basically you need to build the momentum, because as long as you're building the momentum, you will eventually get there as well. This is literally non-negotiable. If I have to literally start over like from the very scratch, I would be focusing on one setup, one time frame, one asset, basically like being a master of one. Because this alone will teach you being a patient, discipline, and much more things that you will eventually tweak in the future. And basically you're gonna be leveraging from this particular method in the long run, as long as you're gonna be very diligent. And obviously you should have some fixed risk basically to survive bad drawdown, which I already explained right here, because it's really important to having realistic expectation. And even though your strategy is maybe, you know, on the paper looking really good, you should have a little bit more, I would say, pessimistic approach, because as long as the money is on the table, you're gonna behave way differently. Nobody can prove me otherwise. I've never seen a single trader who would trade the same way like on the paper. And this is just solely to basically survive bad drawdown and not basically blowing 50% of your account in like 1 week. With this approach, you should be able to, over the course of let's say 1 year or maybe couple of years, to start growing your account. Notice I never said how long it's gonna take there, because it depending on basically your drawdown, your winning, losing streak, basically on your strategy, frequency of your trade. There are so many variables that you need to understand. Realistic speaking, from my personal experience, if you're having a similar strategy, let's say, it will roughly takes 1 or 2.5 years, I would say maybe on average, in order to get these numbers realistically, at least when it comes to the method A. And I'm just speaking from my experience. Now, when it comes to the method B, it's rather beginner or intermediate, because in this particular approach I'm diversifying my capital. What it means is I'm not gonna be putting basically all money to one basket, but basically having let's say 2, 3, or maybe even 4 accounts. I'm saying this is intermediate because it's definitely not for the beginners, because beginners should be focusing on basically one thing only. But if you already having enough discipline, patience, and let's say a little bit experience, you can switch to the method B, which eventually you can play a different trade management or the risk management, so to speak. This is how I kind of discovered that even though trading one strategy that kind of sucks, or on the paper it's rather boring and, you know, like slightly profitable, can be over the long run rather profitable if you're having a little bit different approach. If you're gonna have a different approach, different risk protocol, and the rotation, what it means is, let's say we will have on average 4 losing streak in a row. If you're gonna trade on one particular account, and for the sake of this example, let's say the one trade is 1% risk per account. So basically this is gonna takes you 4% in the drawdown. But let's say that you will have basically 2 or 3 accounts. Usually if this is your biggest losing streak, and again I'm just saying this for the sake of this presentation, let's say based on this simulation or the statistics, the worst case scenario is 4 losing streak. It could be possible that there's gonna be more, right? But let's say we're having 4. If we having basically rotation, meaning we will trade maybe one day a different account. So today you're gonna trade one account number 1, tomorrow you're gonna trade account number 3, and so on, so on. If that's gonna be the case, these 2 losing trades will be, you know, allocated to the account 2 and the 3. Basically on the 4th day of the rotation, you will come back to this account and there's gonna be a winning streak, or basically the winning trade could be a winning streak as well, right? If there's gonna be the winning streak, with the rotation, you eventually start, you know, winning a lot more. What this basically does in the long run is, let's say this is trading one account. As you can see here, there could be maybe a really huge losing streak, but if we trading, let's say 3 accounts at once, the equity curve, like overall, assuming that we will combine all these 3 accounts, they should have a little bit smoother curve comparing to the one, because we basically trying to eliminate all these winning streak by reducing it and, you know, let's say transfer it into the different account. To be honest, we can do so much more with this one, because if we, and now you have to be a little bit nerdy with your statistics, but let's say if in this particular case, if you are going closer to your basically losing streak, you can use this approach and maybe add a little bit extra risk on the next following trades, which eventually, if you're having a positive expectancy, let's say a decent risk to reward ratio, they would help you to recover and eventually grow the account way quicker. But to be honest, I don't want to go too much in detail, just saying the options are almost like limitless in this case, as long as you being diligent and knowing your data. Basically now going back to the method C, and method C, in my personal case, and based on, because I'm trading already for like a few years, I would say this is best, at least in my personal opinion, is best for the longevity. But as I mentioned here, it requires a shit ton of experience and the discipline. That's why I would recommend to basically going from the method A to B to C, and basically not starting right away from the C, because this is really advanced. What that means is we're gonna have a similar approach from the method B. What you can do here is trading basically multiple strategies. I do currently having a couple strategies. I would say actively I have 4 that basically I can rotate, and this alone can be really helpful, especially if you remember we talking about the Ds. So what this approach specifically do is, if one particular strategy is underperforming in one particular, let's say, quarter or the period, so let's say this is the strategy number 1, let's say the number B is maybe, you know, doing rather real well, and maybe the 4th one or the 3rd one is gonna be like kinda neutral, but like over the course of, let's say, 1 year, if you combine like all these accounts and the strategies, eventually you will have this positive expectancy or the outcome. So the approach is basically having multiple strategies, as long as you have the knowledge, discipline, and obviously the strategy. Based on basically the system and the market condition, you can again tweak and the risk your size based on, you know, a particular data. I would say, at least in my personal experience, this is kind of end goal of mine, especially nowadays. The market has been really extremely volatile, and I can see a lot of particular strategies working rather less than, let's say, momentum based strategies now. If I have this a little bit flexible approach, in my personal experience, you becoming much more versatile. You can survive in such a market for way longer. Now let's go to the plan B, and I believe the plan B is probably gonna be for the most of the people, because I would say there's gonna be way higher return on investment, faster scaling, but also the risk will be basically much lower. The good thing about this particular plan is what can eventually fail with the plan A, meaning if you're gonna be like focusing on trading one particular strategy, and let's say you're gonna be, you know, break-even trader in this plan B, you can actually be extremely profitable. But before we move on, I have to say this is way less flexible, so you're not gonna have as much flexibility as you basically having with the plan A. And I'm obviously talking about the prop firms, so there's also a chance of not getting basically getting paid because of some like stupid reasons. We've seen it so many times, right? And sometimes you can see also the companies going bankrupt or end of the service, which to be fair happened to me with the funding ticks, where I started basically trading the futures, purchased a couple accounts, passed the challenge, moved to the payouts, and as I was ready to scale a little bit more, shut down. You have to be also really basically cautious and being fully aware of this. And I would also say there could be also additional pressure, because there are obviously a bunch of rules, so you probably, I personally do have to change the strategy a little bit to being able to trading the pro firms. So again, what we have is plan ABC, and for the beginner, I believe this is a pretty healthy approach. It's basically similar to the method A from the plan A, which you will be purchasing just a small account, and I would highly recommend to having, you know, such a buffer, so you not gonna spend your $1,000 into the highest tier account possible. $200,000 or $100,000 account, you probably don't want to go there. I would basically choose some small account, whether it's going to be 5 to 25k depending on what market you want to trade, because they will eventually give you enough buffer to having way more attempts, and also at the same time everyone having a different approach, or everyone seeing the account a little bit differently, right? So for someone, $10,000 account is gonna be rather decent challenge, and then you're gonna take it, let's say, a little bit seriously. For some people, maybe 10k is not enough and they just gotta treat it as a gambling account and blow it. Obviously, I know a lot of people who gambling even 200k. Well, that's a little bit different story and the problem. Basically, the goal is to have and treat this account to basically test the water and having this proof of concept. What I basically mean is you're gonna be trading some one system, just like I described previously with the method A, and your entire goal is to basically get to the payout. Basically, you have to prove that you have what it takes. As long as you're gonna be disciplined, again, assuming that you're having the trading strategy, you will eventually, with this budget, you will eventually get a payout. Unless you are extremely unlucky and every pro firm went bankrupt or for really stupid reason decide to not pay you. But I would say 99% of the time you will get there eventually. Once you get a payout, that is usually already high return on the investment, because let's say if you purchase for 50 bucks some account, you will probably get something between 100 to $500 depending on your performance. So let's say on average you're probably gonna get $300 back. So you're already having decent return on the investment, and if you're really good or the lucky, you don't even need these $1,000 in the first place. And then basically what you want to do is you want to still keep trading your already existing account and you want to purchase another one that you will eventually trade. How you're gonna approach and trading these accounts will also vary, and you can pretty much use the methods that I already described previously. What I should also mention is you should be focusing on tier 1 or higher the accounts. What it means is if you're purchasing, let's say 10k, after the first payout you're not going to be trading 100k. You probably want to add another 10k account, or maybe you're going to be focusing on 25. What you want to do is you want to increase your account gradually. You don't want to go from basically level 1 to level 10 immediately. This is going to be like a really healthy approach because eventually you will have enough portfolio. And I'm gonna say, if you're not gonna be greedy, which you probably will, it's kind of normal, but once you learn to not be greedy enough, going from 1 to 10k in this particular way is just a matter of months, quite literally. Okay, method B, I assume you're probably expecting what is gonna be. You will purchase multiple accounts. You can basically go all in and spend like $1,000. I wouldn't recommend it. I would still have a few buffers, but you can purchase basically multiple accounts. What I would probably suggest is, at least like personally, if I have $1,000, I would want to have purchasing power of at least 4 accounts, meaning if I have $1,000, I should be able to get at least 4 accounts. Again, we're going to be trading one system and we will have either same or the different risk. I would be a little bit careful with the risk because it happened to me and a couple of friends. Even though if you having a really high win rate, things like that, and risking, you know, more than a certain percentage, the firms will eventually shut you down or limit you really a lot. So be a little bit mindful, read your rules, do your own diligence when it comes to the prop firm, basically rules and stuff. And it's pretty much the same thing. The beauty of this is if you gonna be, let's say, equally successful with the method A, then you will be already having higher return on the investment pretty much immediately on the first payout. So it's pretty much the same step, and after the payouts, what you want to do is you want to purchase another account. But because we purchasing way more accounts at the same time, I really need to advise to having a positive cash flow, because this is pretty much non-negotiable. You don't want to go basically all in and spending basically the entire budget for the next account. I still suggest to having some decent buffer that you can purchase at least 2 or 3 accounts. And similarly, the method C is very similar to the method C from the plan A, and in my opinion is best for the longevity. Maybe I already mentioned it, this is pretty much my personal approach, but I have to say I basically started right here with the method A. Now once I finally understand what I should do, things like that, and what is my strategy, basically this is my approach. I want to be able to having this $1,000 and being able to purchase multiple accounts. I want to purchase multiple accounts on multiple firms solely because we are, or I was basically talking about, you know, not getting payout end of the service, so it's always really good to diversify and basically not putting everything into one basket. To be fair, trading multiple firms you can do with basically each of these methods. Eventually the goal is to diversify your risk across the multiple firms and the multiple accounts. If you're gonna blow few accounts or few firms gonna go bankrupt, you're not gonna experience such a huge damages. And in this approach you can do multiple strategies with the risk basically again based on the system and the condition. I already mentioned it right here. The video is already too long, so I hope you get a point already at this point. You could think of each tree as individual either strategy or the prop firm. Obviously you can play with different risk parameters within each account and the firms, but the goal is again being able to purchase a couple accounts and still have a buffer to purchase more just in case you're gonna fail with some. Basically the approach is pretty much the same, but the beauty of this system, this is literally what I like the most, is depending on the account approach or the strategy, you will have some accounts that are doing rather well, then maybe you will have some accounts that are blowing rather more, so maybe you can cut them off later on, but eventually this will give you so much flexibility to trying different things, and over the long run this is gonna be really huge return on the investment side by side with being basically bulletproof when it comes to some accounts shutting down other firms. It might be a little bit crazy as it looks. If you don't understand anything, let me know down below, but I hope this is gonna find you well.